Hello and welcome. It's Friday. I know. So excited to be here at the weekend. Finally, for most of you, some of you, I don't know. Whatever works for you. You know, my favorite day is actually Thursday, in case you haven't watched any of my videos before, because then you get to look forward to Friday, Saturday, and Sunday, not just Saturday and Sunday. And to bring that point home, there's a lot of people look forward just to the weekend, and I get it, except for if you're living a life or you're working and you're unhappy with what you're doing, and so you just literally work to live for the weekend, then maybe it's time to reevaluate what you're doing. Not trying to say make choices for you, but I'm simply saying I love what I do. I love getting to come on live. Like, I feel like that getting to talk to you and getting to help my clients, it's one of the favorite parts of my day, honestly, to reach out and to be able to provide this opportunity for people to get in touch with an attorney if they need one. And so for me, I love what I do. I love getting to help businesses start. I love to help answering these questions and getting these nuances. So, please, if you're new here, my name is Taylor Darcy from Think Legal, where I help you create the business of your dreams. So welcome. Also, please leave your name and comment, where you're from in the comments below, because I would love to know more about you, my watchers, and if you have any questions, also please leave a comment. We go live Monday through Friday, except for holidays. Like, we didn't go live this past Monday because of, I got new overlays. I got fireworks. Yes! That is so exciting. I get to use those now more. So happy about that. So whenever something exciting happens, I'll probably be using fireworks. Today's episode, we're going to be talking about 7 tips that you need to know before you raise capital for your business. Now, in case you don't know what capital is, we'll talk about that as well. The short version is it's money, in case you were wondering. But before we do that, not only do we go live Monday through Friday, don't forget to hit that subscribe and bell icon to be notified of when we go live on YouTube, because we go live on YouTube, but we also go live on Facebook. But there will be in the future, not now, because I'm trying to build people following and all that good stuff. There will be special YouTube exclusive things. So that's why I want you to subscribe. I know it's like you've got like a bajillion other things to do, but I promise you it will be worth it, because my goal here is to help you with your business. That's my sole purpose in doing these Facebook lives and YouTube lives and all of these different areas where I'm publishing, is to help your business. Because if you are able to stay in business longer, that's more jobs, more security. So for me, this is the opportunity that I have to help put my education and experience to good use. All right, so let's go ahead and get started. All right, number 1. The thing you need to know, like I've talked about this in other videos, so I'm going to not go into it as much detail as I did in others. You can go ahead and look at those other videos for that information. But there is basically 2 types of capital. One is easy, you already know it and love it or hate it, whichever way you want to go with it. And that's debt. You make payments each month, there's interest involved. You just get a lump sum of money. Typically, there are people, you get credit cards that are also forms of debt for companies. They're not as common. They typically are based on a person, not based on a company. That's just the common factor. So when you get a credit card for your business, it might not actually be for your business. It's probably your name, and it just happens to have your business name on it. Because there's not too many revolving lines of credit for businesses. I'm not saying that don't exist. I'm just saying depending on how big your business is, it's not likely that that's what you're using. So you want to check that out. The next one, and this is the least understood but more somewhat desirable type of capital, and that's equity. And equity is the ownership that you have in your business, whatever that may be. So now you have to know that you don't have the option of equity if you are a sole proprietor. It doesn't exist. There's no such thing because people can't have equity in you as a person. They can only have equity in a business entity. So if you're a sole proprietor, this last part of it isn't going to apply to you unless you become an LLC or a corporation, in which case then these equity opportunities apply and you can get outside investors and whatnot. So I just want that to be clear and upfront about what it is that we're talking about before we begin, because these tips apply to getting equity investors. Debt holders, you don't have the same requirement for them because they have no claim on any type of assets specifically. Like as far as let me rephrase that. I'm sorry. They have claim on assets. The equity holders do not. That's what I meant to say. Apologize. So if there was ever a liquidation issue, if you ever had to file bankruptcy or if you ever had to dissolve your company, then the creditors, which are listed as debt holders, are the ones that have first crack at whatever it is money is left over if you're truly going out of business. So that's why this is important. So the equity holders are people that do not have a claim on your assets. Typically, there are some minor exceptions. There are what are called convertible options, but those are well beyond the scope of what I want to talk about today. So when you're looking to get outside money for your business, there are three main types of investors. The first type is an emotional investor, someone that feels joy by investing. And these are people that are going to typically be wanting to find like charitable organizations or a cause that they can believe in. And so they're not looking as much for how much money they can get or the strategy that they're getting. They're looking to get the type of investment into something, think save the whales, save puppies. They're investing in a cause. Okay. So if your cause or your business aligns with that cause, whether it's for profit or not for profit, then you have that option of getting them involved into the business. And so that's what their purpose is. That's what their goal is. So the more you align with those goals, the more likely they're going to want to invest. Now, most people think of investors on these last two. Next one is a strategic investor, someone that has a portfolio of businesses that wants to add to their portfolio and in some way, shape, or form. And so they're looking to diversify what they've already been investing to spread out risk. Diversification is spreading out risk over different entities. The idea, that's why you don't just own one stock. You own a series of stocks so that your risk is spread out over those several investments. That's the essential point behind mutual funds and electronically traded funds, is that they buy and sell a group of stocks in order to make up a portfolio so that your risk is mitigated or reduced over a larger period of them. So a strategic investor is someone who is doing the same thing, but they're doing it with businesses instead of, they're doing it with shares in smaller businesses as opposed to publicly traded companies. That's the difference. And so they're going to be a different person than someone that's looking for an emotional investment. And that's why it's so important that you pay attention to these details and who you're looking for, because if you're pitching the wrong message to the wrong investor, you're not going to be very successful. So the next type is a financial investor, and their sole goal is to make money. And there's nothing wrong with that. And so when they're looking to get the most return on investment. And that's also called ROI. If you've never heard of it before, I hope you have, but if just in case you haven't, return on investment. So they're just looking to get the most money out of what they're spending. So if they're looking for $1,000, they're looking for a 13 to 15% investment. So year over year, that's what they're looking for. It's to get that value out of their money in that respect. A strategic investor doesn't care as much about return. They do. Don't get me wrong. I'm not saying they don't at all. I'm just saying they don't. That's not their primary focus. But what they care about in the strategic is diversifying the risk. Okay, like making it so that their risk is lower. When you put all of your eggs in one proverbial basket and the basket breaks, then all of your eggs go bye-bye, right? So that's what a strategic investor is looking for. Now, so there's different levels of this, right? Some are going to be more one than the other, and maybe there's going to be levels of all three. It's not completely like black and white. Like, you're not going to have someone that's going to invest in your company that absolutely cannot stand you or your product, right? That just doesn't exist. But they might not love, they might not be in it because they love it. They might be in it for those other reasons. So when you're thinking about and getting investors, the number one thing that you can do, the best thing that you can do, is focus on the person that you are looking to get the investment. Don't do the shotgun approach. Don't try to get investment money from everybody that you can think of. Try to get investment money from the one person that has all of these things that your company matches. Now, maybe it might be more than one person, and maybe you're having to do this pitch to several different things, different entities, investors. But the idea being that you don't want to do it to everybody. Like, just because it sounds like a good idea, it doesn't mean it will be, right? So keep that in mind is when you're looking at getting money, getting investors. Focus on the individual, because that's who's event is going to make the difference. That's the person that's going to spend the money to get you where you want to be. Now, this kind of goes with the first one. The next point is, if you do not have a business plan, get one. Okay. Because here's the thing. If you don't, you won't get very far. Investors want to see that you have a plan on making them their money back. It's very simple. I mean, a business plan isn't simple, but the idea behind it is simple. And you want each business plan to be tailored to, no pun intended, you want it to be tailored to the individual. Okay, you want it to be worded. So you're going to have different copies of your business plan, because different people are going to show different levels of interest based on that. And you don't want to hand people a binder of your business plan, not to begin with. It's the equivalent of a guy doing something really stupid on a first date, right? Like, way too far. Like, no, saying I love you on a first date. But that's the equivalent of giving someone a bad idea. That's a bad idea, right? Or a girl. It doesn't have to be a guy. But I'm just saying, like, you hand someone a binder, that's that thick, and they're going to look at it and thumb through the first page and go, nah, I'm out, right? So you're going to have different types of business plans. And then you're going to have different, not just types, but sizes. So you're going to tailor each business plan to each type of investor, but you're going to have a single page and then a multiple page business plan. And each business plan, and this is key, I want you to please, if you're not listening to anything else, please stop what you're doing and listen to this right here. If you're looking to get outside money, the single page business plan has got to get their attention. It's got to show some pop. It's got to show some, wait for it. It's got to show some fireworks, baby. That's what your business plan, don't lie. I'm not trying to tell you to lie. I'm not trying to say, don't do that. But you want some fireworks, because in order for them to give you money, you got to give them a reason to. Okay. And that begins with, you've got to show them the reason why it's kind of like an elevator pitch. They do these a lot more than they used to, but the idea of 1 minute commercial, if you will. But a business plan is more than that, obviously. A single page outlines the highlights. It's a very high overview. They're not looking to get into the minutia that you've written the minutia, but you got to get them excited before they're going to go to the next stage. And the next stage is a 2-page or multi-page, but very small. Still, you're going to be very small. For those investors or those people that are interested, that are going to go, wow, I really like this. Let's see more, but they're not ready for this, right? When you're talking this, they've probably like clued out by then, right? They've zoned out. They're like, oh, I don't think so. So you want to get them a taste. Give them, it's like, samples at Costco or anywhere else they used to do. This is a great example, right? Their sales go up when they do samples for a product because the amount of money that they're losing on those samples, they're more than making up for by the people that are giving them that extra. So the sample is really a great way to think about the business plan. You give them a taste with the first flavor, get them a little bit interested. Maybe you give them a second taste with the 2-page business plan. And that's when it's like, then they're getting ready to buy the whole thing. And that's where the full page business plan or the full Monty business plan comes in. Because unless they're interested, they're out. I mean, you can just rest assured that if they're not interested because your business plan is boring, and I'm not saying that it has to be with fireworks and all that stuff, but it's got to be interesting. It's got to be intriguing. It's got to be something that they can just sink their teeth into and go, yes, I want this business. So there's a lot of work involved, which is why you've got to start early. You've got to start before you need the money. You need to start a year, 2 years before you need the money. This should be part of your plan as a business owner. You should not be trying to get money at the last minute because then you get unfavorable terms. You should be trying to get money early on so that you can continue to grow your business. Okay. So the next thing is, and this is where a lot of entrepreneurs go wrong. So I want you to, like I said, turn off everything. By the way, if you have any questions, please leave them in the comments so that I can answer them. I would love to be able to give you real-time questions. So if you're watching and you're hearing this, or even if you're not watching live, if you're watching after the fact, please leave comments below if there's something you're like, oh, I don't know about this. I'm happy to answer them. I have a fairly quick turnaround time period. Not perfect, but I do. Try to answer them as quickly as possible. So let's talk about the next thing. You've got to focus on the money that you really need. We're not talking the pie in the sky dreams, okay? We're not talking perfect scenario. We're talking about the money that you need to grow, and that's it. We're not talking about dream money, okay? We're talking about the money that will show the investor a positive return and will help your business go to the next level. The last thing you want to do, first of all, if you're flush with cash, what the frick are you doing trying to get outside investors? You should just be using that money to do the stuff that you don't need. And I know some of you are like, well, I want to save that money for later. And having a healthy operating account, by all means. I'm not suggesting don't do that. I'm simply saying that if you're looking to do stuff with the money, before you go and get outside money, use the money that you got, okay? But more to the point, the money that you really, did I say really enough? I'm not sure I did. The money that you really need, okay? If you want money to fall from the sky, is what you're going to apply for. If you don't really need it, and what I mean by that, so you're preparing as though you don't need it because that's the worst time to do it. But then when you actually are there, you're only trying to get the money that you need. And here's why. People are surprised when I say that because of the reason this is the most important. So many people regret giving up equity in their business because you lose a say in how that business is run. And there's a lot of responsibility that goes with it. And we're going to talk about that in just a second. A way to consider doing it is through what's called staged investments. Okay. So you only accept money as needed. You're not on the hook for, and I'm just using this for instance, $100,000. If you're $100,000 in and you need, then you're on the hook for all of that $100,000 versus maybe you can achieve the same result with less. So maybe you only take out 10,000 or maybe 20,000 or whatever that dollar amount is. And The reason why that's important is because then you're not giving up all of your say in your company for that amount, and it keeps you from wasting money too. You want to make sure that by doing a staged investment, you should hold on to that equity because it's going to be more valuable the bigger you get. You want to hold on to that equity until you can't hold anymore, right? You should only be getting money when you absolutely positively need it, no other time. If you can still grow without outside money, then you shouldn't be getting it. But you should prepare as though you're going to need it. Again, this is why I said start a year, start 2 years, start well before you need it to start getting it ready, because it will take time. And you're busy, you're running a business. I completely understand that. I've helped many businesses, and you're not the first, you're not the last. But the idea being that you don't want to be waiting till the last minute. The next point, number 5, be careful with whom you accept money from. The type of investor. You don't want to inadvertently trigger securities laws. So if there's ever a doubt, you want to make sure that you're consulting with an attorney if you're getting outside money. If it's structured as a loan, it's different. If it's structured as equity, then it's different. So I'm not going to go into the crazy in-depth about securities laws because your eyes will glass over and you'll probably drop just listening. But the point is that if you're getting outside money that's not a loan, not debt, okay, so promissory note, all that good stuff, then you want to make sure that you're not going to trigger securities laws. So it's because the SEC, you don't want to mess with. Like they don't even require that you did anything on purpose. That a lot of the issues are what's called no scienter, which is short version of is you don't have to have a guilty mind in order to be convicted of breaking SEC rules. Yeah. So you could not do it or you not mean to do it and you do it and you can still get hurt. They can still come after you. Okay. And if it's serious enough, you could have not only a lawsuit on your hands, but the Department of Justice at you. If you've taken money that you shouldn't have, securities are not something to mess around with. And it's something that it's important that you know what you're getting yourself into. As well as your investor. Most of these types of levels of investors are, if they're serial investors, are going to know about securities laws and are going to know how to work with them. The people that you worry about is your rich uncle or your rich somebody that is a family friend that could trigger securities laws, might not. You need to go through the whole process to figure out if it triggers securities laws. So the next thing is, and this is so important, okay, know who you're borrowing money from, which translates into due diligence, and some more due diligence. I'm not saying to be paranoid, but a great rule of thumb is if it sounds too good to be true, it probably is. If someone's, or the reverse of that, if someone is coming with, looking to invest with so many strings attached, run, because you're going to have a terrible relationship with them. This should be a positive, beneficial relationship with your investor. Okay, this should be somebody that you trust, somebody that you know or have gotten to know, someone that isn't coming to your rescue and saving you in the ninth hour, right? It should be somebody that is giving you this as a way to what's in it for them, right? That's what you should be focusing on. But the point is, you want to know who you're getting into, I don't like the term, but getting into bed with, okay, is one way of looking at it. Because otherwise you could end up being really hurt. Your business you could get destroyed in your business. And that's terrible. I mean, that's just wrong that something like that would happen, that you would run that risk just for the sake of getting money. Okay. Because it's not worth it at that point. So that was number 6. Number 7, are you really, and I won't do so many reallys on this one, are you really ready to be responsible like that? Because now it's not just your neck on the line. It's somebody else's money. You now have a fiduciary responsibility to that investor. You now have more people looking over your shoulder that might not be enjoyable, and it may be more stressful for you. So maybe it's better to not, as I've said before. Please don't misunderstand this. I'm not trying to talk you out of getting more money for your business. That's not what I mean. But too many people try to do it too fast without enough revenue or enough proof that they can get the revenue. Think Shark Tank. If you ever watched it, I've talked about him a few times on here. Shark Tank gets a lot of people just hoping and praying without a good business plan or without a good strategy for getting more money. So if you can't point to how the investor is going to get their money back and make a profit, then you might want to reconsider asking for that money at that point. Maybe later it works out perfectly. I don't know. I'm not suggesting that you have to do it this way. These are the things that are going to get you the best result, the fastest, and without getting screwed. I mean, just put it bluntly. The last thing you want to do is accept money from someone bad, or they get screwed, you get screwed, and there's a lawsuit involved. And that's just the tip of the iceberg. So these are all things that I want you to think about before you're getting that extra money. As I said before, we go live Monday through Friday at 11 a.m. So please join me and feel free to leave comments and let me know where you're from. And if you have any more questions and want to reach out, my website is thinklegalpc.com. And I look forward to talking with you soon. We'll see you next week. It's Friday. Woohoo! Talk to you then.